Hi guys, I'm Nicola Mackenzie, founder at Dun & McCarthy Mortgages, and in today's video I'm joined by Paul Zammit, who's the director at the Loans Engine, and we'll be talking all things second charges. So if you're thinking about borrowing additional funds against your property, then this video is one not to be missed. Maybe you're thinking about doing some home improvement, buying a second home, and your existing lenders told you no, or maybe they're charging some hefty fees for you to do it. In which case, then you need to stay tuned for this interview. Now, before we get into the detail of today's video, guys, make sure that you hit that subscribe button and the notification bell so that you don't miss any future video uploads. And also make sure that you comment in the comment section, ask questions, and also make sure that you give it a thumbs up if you enjoy it. So, Paul, lovely to see you.
Thanks, London. No, thanks for having me. Really appreciate it.
No worries. Honestly, we appreciate you coming onto the channel for this interview. So thank you for joining us. So can you start then, Paul, by giving us a bit of an overview, just real basics on what a second charge even is? Because I know what it means, but I'm sure a lot of the viewers, it doesn't mean much to them.
No, absolutely. So following on from what you said at the start of the intro, really. So a second charge, it's commonly known, I guess, as a secured loan, a homeowner loan. But in essence, it's where you are a homeowner, so you own your property, which is mortgaged, and that's the most important thing with the second charge, is that you have a first charge, which is a mortgage in place first. And as you said again, following on from the intro, where you're looking to raise extra funds, you know, typically, if you're looking to capital raise, as we call it in the industry, borrow more money, you would just approach your mortgage lender or your bank, and you would typically, more often than not, be approved, and you would get the funds from them, whether it's for home improvements or debt consolidation. What we're finding now, of course, is that under the current climate, under current circumstances, that banks, high street lenders, or even lenders that aren't necessarily on the high street, have tightened their belts, and so therefore obtaining that further advance, as we call it, that extra bit of money, is becoming harder, and that's where second charges are becoming more prevalent. So in a nutshell, second charge is, as it says on the TNA, second charge, but basically where your mortgage is your first charge, a second charge sits behind that, but they essentially take on a bit more risk from their perspective. But actually, you'd be sitting there thinking, well, if I'm looking to raise more money to clear my debts, for example, which is the most commonly used reason for a secured loan, you'd be thinking, well, I want to borrow, let's just say 30,000. I want to clear these credit cards off. I'm paying, let's say, £600-700 a month. If I reduce my outgoings to, £200 to £300, surely that means it's more affordable in the lender's eyes. But actually, that's not all the way. They don't always look at it in that way, and that's sort of the problem. And that's where second charges come into place, where essentially the first charge, high street lender, etc., just doesn't want to lend for whatever reason. But it's with a separate company. So let's say, for example, you have your mortgage with ABC Bank on the high street, and I've just made that up, but ABC Bank, the secured loan will be with a separate company, which is typically not available on the high street. You have to go through a specialist master broker like ourselves, the Loans Engine, in order to obtain that finance. So that's in a nutshell what a second charge is. People always assume that, okay, well, if I can't get it from the high street, it's going to be super expensive. Well, that's not the case. I mean, to put it into perspective, mortgage rates at the moment at best hover around the 4%. Well, second charges are hovering around the sort of 6%. And on the basis that second charges are there in the main as a stopgap, although you can take them over 25, 30, 35 years, just in the same way that first charge, your mortgage, can be taken over, more often than not, a second charge is in situ for about 2 to 3 years. Because just because the client or the customer is not able to obtain that finance from the high street now, it doesn't then mean in 2 to 3 years' time that their circumstances haven't improved. They can remortgage themselves out of that and get them back onto a better rate. And that's what we're here as the Loans Engine. I always say we start where the high street stops. Just because you can't get it now doesn't mean in 2 to 3 years' time you can't.
Sure. Okay, good. Can you then, Paul, tell us a little bit about loan to value in terms of how that relates to second charge mortgages and what restrictions it can have on second charges, etc.?
Okay. So loan to value in its most simple form is essentially the liability. So your debt, your mortgage or secured loan coupled with that against the value of your home. So in its basic shape and form. If you own a property that's, let's just keep it simple, worth £100,000, you have a mortgage that's £50,000, well, your loan to value is 50%. Second charge loans can go to 100% loan to value. So in theory, you can borrow an extra £50,000. But there are products to serve those to go to 100% loan to value. So for example, first time buyers or people that haven't been on the market, the ladder as long, let's just say you buy a property, you buy it for £100,000. You mortgage up to 90% of the value of the property. So minus off fees, you're circa around about £90,000, so 90%. And then let's say you carry out works on the properties. You use personal debt, credit cards or loans to facilitate that. Let's say you spend £25,000. Well, in theory, your property then will have increased. Let's just say
I think so. If you've gone through all that time and effort.
Yeah, absolutely. Let's say it's increased to £140,000. Well, or even keep it more simple. Let's say to £150,000. Well, then your loan to value at which point is lower, which then means that you're able to then borrow further against the property, assuming your circumstances remain the same or improved, and you can secure a secured loan against the property.
Yeah.
Let's just say that £25,000, or you need to finish off a little bit more, so you say want to raise an extra £5,000, but you've gained the equity in order to do so. Because even though you would have, let's say, in theory, been able to borrow money day one, the rate would be more expensive because the higher the loan to value, the more risk it is for the lender.
Yeah.
And again, it comes back to what we talked about earlier in regards to, if you were to default or miss payments, the worst case scenario is they have to repossess the property. I don't want to talk about it or labour the point too much, but from a lender's perspective, the higher the loan to value, the more risk if they were to have to eventually repossess, that of course there's less of a chance of them recouping their funds.
And with negative equity as well, there's a potential risk. And,
absolutely, of course, and again, that's always a risk. Even back, 2007, 2008, there was a lot of talk about negative equity, but actually in the long run, if you look at people that bought properties back in 2007, 2008, yes, for a short period of time they would have been in negative equity, but now in today's market, they're in situ, they're probably less than 50% loan to value. So actually in the long run, in my mind, it always works out best to be a homeowner because you have an asset at the end of that time.
I couldn't agree with you more. Property should be a long-term investment, in which case trends tell us that the price goes up over time. So I completely agree with you. And just going back to what you mentioned about the 100% loan to value, Paul, because we see a lot of first-time buyers that do want to do those renovations straight away. So again, you spoke about the fact that from day one, second charge isn't an option even for first-time buyers if they do want to take on a project where there's a lot of work involved. That can be beneficial.
Yeah, absolutely. Yeah, and because we do get a lot of clients that when they come to us and they have limited equity in the property. So whether it's the day one, so they what we can't facilitate unfortunately is a simultaneous first time buyer second charge loan. So for example, you're borrowing £90,000 from ABC Bank and your mortgage and your property's worth 100. We can't then facilitate the extra 10,000 on top. But once they're in situ, so once they they're in the property, they're on the voters roll, because that's the key thing as well. Been on the voters roll, secure, your credit rating increases even just because of that. Once you start paying bills, but even if you've just made your first mortgage payment, we are able to facilitate a second charge. So if it's, let's say, £10,000, we do have even a lender that will go slightly above on the 100% loan to value mark, even to 140% loan to value, but the loan sizes are reduced. Typically they cap at 10 to 15,000. So if we're talking,
sense.
Because it's more of a personal loan, just with that added comfort charge is what we call it. But essentially, let's say again you buy a property for £200,000, and let's say you mortgage up to £170,000. Again, once you sort of made your first mortgage payment, we can look to place you with a lender that will range anything from 25 to 30,000, depending on the cost involved, up to 100% loan to value.
Wow, brilliant. And I think that will be really useful for people to know, because I think I said this to you before the video off air, that a lot of people don't actually know what a second charge is, let alone how it can benefit them.
No, that's right. I read a stat recently. I think 3/5 of homeowners are completely unaware of what a second charge is.
This is it. One of the main reasons I brought you here today, because I thought this is important for people to know. So
absolutely. It's funny because when I talk, if I'm at a social event and people, what do you do for a living? It's easier just to say, look, we're a mortgage brokerage. But actually, so what more sort of mortgage? And I go into more detail. They're like, do you know what? I didn't even know this stuff existed.
This is it.
Because it's not on TV, it's not, on the radio. It's we deal with brokers like yourself. And we do, we have a consumer offering as well. So, we have a website. But actually what we do, where it's not on the high street, it's not in your face. So,
exactly.
they're just completely unaware of the options. They just, someone's looking to raise money for home improvements, let's just say. If they go to their bank, they get knocked back and it's a large sum. Then they just think, oh, no one's going to help. They just forget about it and then try again in 6 months. And unfortunately, a lot of the time, then they get knocked back again in 6 months because circumstances haven't necessarily materially improved.
Definitely.
But second charges are an alternative way of borrowing.
Definitely. And what would you say to someone then that's sort of on the fence? Should I take out a personal loan? Should I come to the loans engine and look at a second charge? What advantages would you say apply to a second charge over loans?
So I guess the two key advantages is loan size. So inherently secured loans are taken because you can borrow significantly more than a personal loan. So if you have a good relationship with your bank, in the main you can borrow maybe up to £30,000, but you're certainly restricted on the term. So you can, generally speaking, at best get that over 7, at a push 10 years. But of course, what does that mean? The payments are significantly higher. And so with a second charge, coming back to what I think I mentioned before, you can run it alongside your mortgage. So if you have 25, 30 years remaining on the mortgage term, again, assuming you meet other criteria, you can stretch it over that term, thus reducing the payments at a rate which, again, is typically better than personal finance as well. One thing I would say, and this is the truth, is that if you're looking to raise small amounts of money and you can afford a shorter term, then absolutely personal finance is generally the best way to go. But we are generally then talking up to amounts of 15,000 over 7 years where payments are affordable. But if your gut is telling you that that's going to be a stretch, that is essentially where a second charge definitely comes into play. Because if it's affordable and you don't need to secure it against the home, why would you? But that's where a lot of bear in mind, our average loan size on a second charge, to put it into perspective, is £65,000. Which still it amazes me sometimes. It's a huge sum, and that's where the key advantages are: loan size and term, and rate as well. Admittedly, because you are willing to put your property up as security, so as a benefit, you will then secure, generally speaking, a better rate.
Yeah. But like you say as well, it's not necessarily it doesn't have to be a long-term arrangement.
No.
So like you say, you can potentially remortgage out of it, etc.
Yeah, absolutely. Yeah.
But there are still many benefits to considering a second charge over a personal loan. So I agree with
absolutely. You. Yeah, absolutely. Yeah.
Okay, so that's looking at the advantages, Paul. Can you tell us then a little bit about some of the disadvantages that might apply to a second charge?
Yeah, absolutely. I think with anything in life, there's always pros and cons.
Exactly.
Without a doubt. I guess that, the main disadvantage is if you do not keep up the repayments on the second charge, your home is at risk of repossession in exactly the same way that the first charge is. There's no difference.
Yeah.
And they are regulated. I'm not sure I mentioned this before, but they're regulated in exactly the same way that a first charge is. And so
there's still affordability, checks to pass, etc.
Yeah, exactly. Yeah. The industry in itself it's changed a lot over the last 10 years, in the main since 2016 when it moved and it was aligned completely with first charges. But that is the key disadvantage. I guess another disadvantage from a long-term potential perspective is where you're looking to consolidate debt. Potentially you may pay more back in the long run, because if you take a basic example of, let's say you have 3 loans totaling £45,000. You're currently paying, let's just say for argument's sake, £800 to £900. But again, we mentioned before where the cost of living has impacted people, to come out of the blue, they're no longer to afford those debts, where previously they would have had them paid off within 5 or 6 years or whatever it may be. They need to reduce. So the need from the client's perspective is to reduce outgoings so that at some point in the future, when things improve, they can then look to redeem, with a first charge, remortgage. The disadvantage is potentially, if they were to keep it over the long term, that they would pay more interest. However, and statistically, and the stats tell me from lenders, MI, etc., that actually loans generally on a second charge basis are kept for no more than 2 to 3 years. But there's always that risk that if you were to keep it long term,
yes,
you would pay more interest.
Again, though, it's no different really to a first charge mortgage.
Absolutely
The
not.
longer you stretch the term,
Absolutely.
great, your payments are lower, but you are going to pay more interest. We can't have it all.
No, well, that's it, and that's the key thing for us. Is, where we're recommending a second charge.
Yeah.
The primary need, generally speaking, is to reduce outgoings.
Yeah.
Because otherwise, it will just spiral. You end up then at a point where you're having to, I don't like to use the term rob Peter to pay Paul, where you're then using other personal debt to satisfy the debt you had. It just builds and builds and builds. Whereas a second charge can take that payment from, let's say, £800 to £900 down to £300. Freeing up, £500 to sort of £600 or whatever it may be, which is a huge sum. It's a pay rise in itself for a lot of people.
Definitely.
And then, again, 2 years down the line, you guys can then take that with a remortgage, put them back onto the high street. Again, probably at a lower rate. And again, paying less interest in the long run.
So you mentioned debt consolidation. I'd imagine second charges are fairly common for that, popular for that. We spoke about home improvements. What other uses do you see generally for raising money?
I think it's seasonal, to be honest. So I think throughout the year, debt consolidation is always a feature. In fact, I think if I was to probably pull out some MI from the last or information from the last sort of 3 months, debt consolidation would account for 75% of the loans, or at least some form. So it might be debt consolidation and home improvements.
Yeah, okay.
But tax bills, this time of the year, business purposes, injection. So let's just say someone's bought a a premise on the high street. Things are going well, but they want to expand. They want to get more stock in. They don't want to use personal debt. Again, coming back to they don't want to have that high monthly repayment. We can place a second charge on the client's main residential home, let's say for £30,000-40,000 to bring in stock, factory equipment, whatever it may be. Equally, we do have clients that have rental properties, buy-to-lets, and sometimes they, of course, have their own residential home. We can place a second charge on their buy-to-let in exactly the same way that we talked about before, whether it's for debt consolidation or whether it's for home improvements to the residential business, whatever it may be. Any legal purpose is the truth. So, as I said, I know we talk a lot about debt consolidation, home improvements, but tax bills, car even, dream holidays, weddings, again, seasonal, weddings, any legal purpose.
So pretty much most things.
Anything, basically, yeah.
Okay, excellent. And what about then, in terms of fees, of course, it's going to vary depending on who the lender is, etc.
Yeah.
But can you give us a rough idea on what we're talking about with a second charge?
Yeah, so I give Loans Engine as an example. We try to keep the fees as low as possible, whilst at the same time operating a business and a profit. That's what we're here ultimately to serve clients, but of course we need to do that in a profitable way.
Of course.
Fees, however, will typically range. So we offer loans from 15,000 upwards.
Yeah.
But the
so
fees,
that's the minimum that I can come to Loans Engine for.
Yeah, I say that we do have some off-panel lenders as well, which can raise anything from 3,000. Is the truth.
Okay.
It's just that most of our average loan size is £65,000. Fees, however, they generally work as a percentage with a lot of brokers, but with ourselves, we have a flat arrangement fee. Unless it's under £20,000, where actually fees start from around about 2,000, but they're added to the facility. So again, coming back to, and I say facility, again, I'll put layman's terms, they're added to the loan. So they're absorbed in the monthly payment.
Yes.
So we don't charge any upfront fees. So especially, bear in mind, most of our clients are looking to debt consolidate. They don't have, if you were to ask me to pay a £2,000 fee, that's a big chunk.
That's a lot of money,
it's a big chunk of money. But they range from £2,000 to £3,000, depending again on the complexity of the case and the lender as well, and what's involved in the process.
What would you advise, just generally speaking, I'm a customer, I'm looking to consider a second charge loan. What general advice would you give to me?
First and foremost, if you're looking to raise extra funds, is to absolutely speak to your broker, because they might well be able to obtain a further advance, which generally speaking is cheaper. There are less fees involved, but I would say always visit the broker, because then the broker, if they can't obtain that, will then refer you to a brokerage like the Loans Engine, where we are, to use the old term, whole of market. So we have access to the majority, if not all, the lenders in the second charge world. Because as a consumer, from a client's perspective, if you're looking to obtain a second charge, generally speaking, if you were to go online and try and obtain that yourself, you're limited to the offering. There's not many lenders that have a direct offering. So whereas, let's say, if you're looking to raise a mortgage, for example, there's lenders that you will have access to that clients don't have access to themselves.
Of course,
and again, they might be looking to buy a property, they have a bit of adverse credit, they look on the high street, they walk into, again, let's say ABC Bank, their criteria is quite, you can't have any missed payments. They think, oh, no one can help me. It's exactly the same as the second charge as it is the first charge.
I'm sure that viewers found that really, really informative.
I hope I've helped. It's sort of where I get to, yeah.
Most definitely.
Yeah.
So thank you so much for your time. And yeah, comments, questions, drop in the comment section below, guys. Make sure that you subscribe to the channel, hit the notification bell so that you do not miss any further videos from DM Mortgages. And of course, if you do want to discuss second charges, then I will put contact details in the description below. Get in touch with us and we would be more than happy to help. Until next time, see you later.